What's going on, guys? We're back again with another video, and in today's video I'm going to be talking about the formation of a candlestick. Now, people actually think that it's impossible to predict the formation of either a bullish candlestick or a bearish one, but I beg to differ. In this video, I'm actually going to be discussing with you how to actually anticipate and frame your trades based off of the formation of weekly and daily candlesticks. Now, this is going to enhance your daily bias and your weekly bias and take that to the next level, so it keeps you in high probability market conditions when you're looking for trades week in and week out. Now, if you go to the description of this video, click the link. It will take you directly to my free Discord where I talk about this topic on a weekly and a daily basis. Now, let's get right into the video and get to the topic of discussion at hand. All right, guys, here is the formation of a weekly bullish candlestick. We have the open, a low, a high, and a close. Now, in order for us to be a part of the distribution part of this weekly candlestick, we need to form and frame ourselves in the low end of the candlestick. So I'm going to show you guys a little bit more detailed explanation of the formation of this weekly candle. So when we're going to be in a bullish bias for the week, we want to be positioning ourselves in a long position inside of the wick of that weekly candle right here, because what is happening inside of this wick is this low is actually reaching a key level, and a key level could be an external range liquidity pool, which is an old high or a low, or it could be an internal range liquidity pool, which is a fair value gap. That is where you want to be framing your trade position on the anticipation of an open low high close weekly candle. Now, looking more deep inside of this, if you're trying to trade the distribution of the bullish weekly candle, you want to be executing on the 4-hour chart, because our time frame alignment is weekly key level to a 4-hour market maker buy model if we are bullish. So if price is running an external or into an internal range liquidity pool, you're going to want to watch the 4-hour chart based off of that weekly key level tag. So what I'm going to show you guys in the future of this video is an example of exactly how we can frame a trade inside of that weekly manipulation wick. Now, looking at a bearish weekly candle, it is the same thing, but vice versa. We have an open, we have a high, we have a low, and we have a close. If we have a bearish weekly bias, you want to be framing yourself in a short position inside of the weekly candle wick above the open. So if you're trying to trade the distribution of a weekly candle, you want to be executing again on the 4-hour chart. Now, the 4-hour will show us an execution or a trade inside of this wick so that we can catch the entire weekly range move. And again, like I said, our time frame alignment is weekly key level to a 4-hour market maker sell model if we are bearish. Now, let's just get right into some chart examples so you guys can see and have a better picture. All right, guys, like always, this is a blank chart and we're looking at the NASDAQ on the weekly. So before I show my annotations, I want you to mark up yours and see if my annotations match yours on the next slide. So based off of what we talked about before, like I said, we are expecting, if we're bullish for a weekly bias, we are wanting to see price reach a weekly key level, which is this internal range liquidity pool. And you want to be positioning yourself in the wick below weekly open here, and below weekly open here. And if you see as well, we have a tag of a weekly internal range liquidity pool, which is that key level, and we created SMT diversions inside of that key level. So based off of my checklist that I've given out before, we need two things to happen: internal range liquidity pool tag and SMT divergence. And we're adding on to buying below weekly open if we are bullish for a weekly bias. Now, our time frame alignment is weekly to 4 hours. So what we're going to do here now is frame the trade on the 4-hour chart and look for a long position below weekly open. So now let's go to the 4-hour and see if we could frame our trade. So here is our 4-hour depiction on the NASDAQ, and here is the dashed line of weekly open, and see if you could frame the trade based off of just this chart and mark up your annotations before I show mine on the next slide. So if you got that correct, we have a down close candle resting right here that swept liquidity, created the SMT, and it got tagged below weekly open. This PD array formed below weekly open. We can execute long on that tag because we're trying to buy below the wick and be a part of the distribution phase of that weekly candle to reach that weekly external range target, this resting buy side liquidity pool. So we're entering long here, stop loss at the order block low, and price runs directly to our weekly external range target. This is a weekly to a 4-hour market maker buy model. Moving on to the next example. We are now framing a weekly open high low close with a bearish weekly bias. Now again, pause the video before I show my annotations on the next slide so you can compare. So if you got that right, we are looking at Euro USD on a weekly chart. So we have a weekly key level tag, this internal range liquidity pool, fair value gap, and like I said before, you want to be positioning yourself in the wick above the weekly open, inside of this gap. And you could see we also had SMT divergence with the dollar index. So we had higher highs on euro. We also had higher lows on the dollar index, giving us our SMT divergence. So we're on a weekly chart. Now we're able to frame a 4-hour market maker sell model above weekly open to see if we can execute a trade to the external range lows. So looking at the 4-hour chart on Euro USD, we have the weekly open here. This is where you want to be selling above, and this is our key level tag, the internal range liquidity pool. Now before I show my annotations as to where you could be executing price here for a short position, I want you to pause the video and mark up yours before I show mine. So just like the trade that we had on the NASDAQ, we have a up close candle resting right here that ran liquidity, and then the following candle here closed below it, identifying a change in state of delivery and confirming a 4-hour bearish order block. So if I wanted to execute, I'm above weekly open, and I had a change in state of delivery and an order block confirmation at that weekly internal range liquidity pool tag. So I'm just stacking pieces of confluence together to frame myself in a trade that positions myself to catch the move of the weekly candle's distribution lower. So execute here, stop loss at the resting high that created the SMT, take profit at the weekly external range liquidity pool. And as simple as I said it, we had price distribute lower, selling opportunity was above weekly open, and take profit was at the weekly external range lows. So we just covered the weekly open high low close and open low high close, bullish and bearish candles. Now we're doing the same thing, but we're going to be doing it on a daily open low high close and a daily open high low close. So this is the bullish candle on the daily, and the only thing that's going to be different here is our time frame alignment. The same thing goes with our weekly expectation, but for the daily expectation, our time frame alignment is a daily key level tag, and we're framing a 1-hour market maker buy model if we are bullish. So here we have a run into an external or an internal range liquidity pool on the daily candle, and we want to be positioning ourselves long inside of the wick below the daily open. And we're able to frame a market maker buy model on the hourly, identifying a position entry inside of this wick so that we can catch the candle expansion higher to whatever external range target we have on that daily chart. Same thing goes for a daily bearish candle for an open high low close. We have a daily key level, an external or an internal range liquidity pool tag at that high inside of the wick, and we're positioning ourselves short on our hourly chart inside of this wick when we reach that daily key level. Again, our time frame alignment is daily to 1-hour market maker sell model if we are bearish. So here is a daily chart on the GBP JPY, and like before, I want you to pause the video, mark up your annotations before I show mine on the next slide. Isn't this starting to look familiar? And how all of them are kind of replicating themselves from another. So we have price reaching a daily internal range liquidity pool, this imbalance, and we have SMT divergence here with Euro JPY. And what we want to do here is position ourselves in the wick below daily open. So there is an entry on the 1 hour inside of this wick that we can capitalize on to reach any external range highs above us. So here's the hourly chart, and this is that daily open. Anything that is below here is labeled as a buying opportunity. Now, just like I had the same examples and the same structure on both the weekly bullish and bearish bias, it all correlates to the daily as well, because price is fractal. Whatever happens on the higher time frames on the weekly can also happen on the daily, and if it happens on the 4 hour, it can also happen on the hourly. So just like I said before, pause the video, mark up your annotations, see if you could find the entry, because I'm going to show my annotations on the next slide. If you got that correct, we had a down close candle resting right here that swept liquidity, created our higher time frame SMT. We closed above it. That is utilized as an entry point that you can go long here, stop loss at the order block low, and look to take profit at that daily resting external range liquidity pool. And like I just said, as simple as it is, price reaches that order block tag, very sensitive area in price, and drives to that external range target, and our entry was below the daily open of that candle. Moving on to a daily bearish bias. So we're looking at Euro USD on our daily chart, and like I did before, mark up your annotations, pause the video before I show mine on the next slide. Just like every single other example that I just showed you guys, we have price tagging a internal range liquidity pool on the daily, creating SMT divergence with GBP USD inside of that daily gap, and we're looking to position ourselves inside of this wick above daily open if we're bearish. We're trying to frame our trades above the open. Now, looking at the hourly chart, our aligned time frame, here is that dashed line where we had the daily open, and here is our SMT run on the highs inside of that daily key level. Now pause the video, see if you could frame your trade and compare the previous trades to this one and see if your annotations match mine. And I hope that you were able to get that, because we had this up close candle resting here that swept liquidity, and we had it close below on this massive down close candle. So we had displacement, price retraces back into the range. We tagged that order block so we can go in resting right here, stop loss at the order block high above that daily internal range liquidity pool, above daily open, and we're looking to take profit at the daily external range liquidity pool. And such an easy and simple topic that keeps you guys on the proper side of the market if you have a strong bullish and bearish bias on a weekly or a daily perspective. What I'm doing for you guys here is I'm just giving you very simple steps and little puzzle pieces that you can use as such strong factors to your trading arsenal that can keep yourself in high probability trading conditions. Because what we're trying to do here is basically counting cards in a casino. All we're doing is trying to gain more and more knowledge and study and study and study so that we have a better edge against the house. Now, I've already showed you guys the base foundation of my model, which is internal and external range liquidity, SMT divergence, and now adding this third piece of the puzzle, which is selling above daily open if bearish, buying below daily open if bullish, and the same thing for weekly, buying below weekly open if bullish, and selling above weekly open if bearish. Add these to your trading arsenal, and I promise you, your win rate will increase dramatically. Now, I hope this was of value to you. I hope you guys learned something. Go back in the markets, back test this, forward test this, whatever need be. But like always, I appreciate you guys, and I'll catch you next week in the next upload.